Paying off your mortgage feels like the finish line, and it is treated that way by almost everyone who reaches it. In reality, it is closer to a starting line for 7 specific moves that most homeowners never make. Plus one brand new tax deduction that has nothing to do with your mortgage at all, but affects nearly every homeowner over 65, regardless of whether their home is paid off or not. Skipping these moves does not cause an emergency, which is exactly why they get skipped. Nothing forces your hand the way a missed mortgage payment would. But skipped for long enough, they quietly cost real money, real protection, and in at least one case, a genuinely large tax deduction you are legally entitled to and simply never claimed. Today, I am walking through exactly what to do the moment your home is paid off, whether that happened last month or 15 years ago. And the new deduction worth up to $6,000 that has nothing to do with your mortgage at all. My name is Robert Hensley, and every week I go through the actual rules behind moments like this one, because nobody sends you a checklist when your final mortgage payment clears. The bank just stops sending a bill and moves on to the next customer. I am not here to sell you anything, and if you're new here, hit subscribe and tap the bell now, since new videos post every Wednesday and Sunday. 2 very different homeowners are watching this right now, and each one has a reason to assume it does not apply to them. So let me address both before the list even starts. If you just paid off your mortgage recently, you are probably feeling the relief of the finish line right now. And you may assume the hard part is over and there is nothing left to actively manage. There is, and several of these items have real deadlines attached to them. If you paid off your mortgage years or even decades ago, you likely assume a video like this is for someone newer to the milestone than you are, and that anything relevant to you would have already been handled long ago. That assumption is exactly what leaves real money on the table, since several of these items, especially the new tax deduction, apply to you today, regardless of when your mortgage was actually paid off. Stay through the whole list, because the tax deduction is the single highest value item here, and I am not going to make you wait until the end for it. Move number 1. Close your escrow account properly. Not just assume it closes itself. Your mortgage servicer was collecting extra money each month specifically to cover property tax and homeowners insurance on your behalf. And once the mortgage is paid off, that escrow account gets closed and any remaining balance gets refunded to you. That refund does not always arrive automatically or quickly, and homeowners sometimes wait months or forget to follow up entirely, leaving their own money sitting with a former lender. Call your servicer directly, confirm the escrow account is closed, and confirm exactly when and how the remaining balance will be returned to you. From that point forward, you are personally responsible for paying property tax and homeowners insurance directly yourself on your own schedule, rather than having it handled automatically inside your monthly payment. Move number 2. Check whether you qualify for a senior property tax exemption or freeze in your state, since this is exactly the moment most people start thinking about it for the first time. I covered this in detail in a previous video, including the 4 real categories that exist: homestead exemptions, assessment freezes, deferral programs, and circuit breaker credits, along with a free tool to check your own eligibility across all 50 states. So I will not repeat the full breakdown here. I do want to flag it as part of this checklist specifically, since paying off your mortgage is exactly the moment many homeowners start paying property tax directly for the first time, no longer bundled into a monthly payment, and only then start asking questions about whether relief exists. If you have not checked yet, that earlier video walks through exactly how, state by state. Move number 3, and this is the one I promised you, the new tax deduction that has nothing to do with your mortgage at all, and applies whether you are debt-free or still paying one off. Under a piece of tax legislation signed in 2025, taxpayers 65 and older can now claim an additional $6,000 deduction, $12,000 for a married couple where both spouses are 65 or older, on top of whatever else you already claim, whether you itemize or take the standard deduction. It is in effect for tax years 2025 through 2028, and it phases out starting around $75,000 of income for a single filer and $150,000 for a married couple filing jointly. It is not automatic. You have to actively claim it using a specific new form when you file. Independent analysis has noted that fewer than half of eligible seniors are actually expected to benefit from it once the phase-out and interaction with other deductions are factored in. So confirm your own eligibility with a tax preparer, rather than assuming it applies to you at the full amount. If that deduction was new to you, hit like right now so it reaches the next homeowner who has not heard about it yet. And if you have not already, subscribe, since I will keep covering exactly this kind of provision that gets buried in a much larger bill and never explained clearly anywhere now. Back to the list. Move number 4. Redirect your freed-up monthly payment on purpose, immediately, before it simply dissolves into everyday spending, without you ever consciously deciding where it should go. A mortgage payment often represents one of the largest single line items in a household budget, and when it disappears, that money does not automatically go anywhere productive. It just stops leaving your account, which feels like extra room, rather than a decision that actually needs to be made. Redirect it deliberately toward an emergency reserve if you don't already have one built up to a comfortable level, toward the property tax and insurance bills you are now paying directly instead of through escrow, or toward a specific goal you actually choose and write down somewhere. The households who benefit most from paying off a mortgage are consistently the ones who give that freed up money a new job immediately, on purpose, not the ones who let it quietly disappear into daily spending over the following year without ever noticing where it went. Move number 5. Check whether your homeowner's insurance still covers your actual replacement cost, since this has nothing to do with your mortgage payoff directly, but tends to get reviewed at exactly this same life moment, or worse, never gets reviewed at all afterward, once nobody is watching. While the mortgage was active, your lender required coverage and often kept an eye on it as part of protecting their own collateral in the property. Once that mortgage is gone, nobody is checking on your behalf anymore, and construction costs generally rise steadily over time, meaning a policy that was entirely adequate when you first bought the home can quietly fall behind what it would actually cost to rebuild it today, sometimes by a significant margin. Call your insurance company. Ask specifically for a replacement cost estimate based on current construction pricing in your area, and compare it directly against your current coverage limit, rather than assuming the number from years ago still holds up the way it once did. Move number 6. Look into a transfer on death deed for your home, a tool that lets you name a beneficiary who inherits the property automatically when you pass away, without the estate going through probate court at all. This is currently available in roughly 30 to 32 states, plus Washington, D.C. Not everywhere. Florida uses a different tool called an enhanced life estate deed instead, and Pennsylvania does not permit this type of deed at all. So confirm whether your specific state offers it before assuming it applies to you, the way it might to a friend or relative living elsewhere. It does not protect against Medicaid liens or creditor claims against the property, and in several states, it gets automatically revoked by a later divorce if you named a spouse as the beneficiary, or by a later marriage and the birth or adoption of a child. So it genuinely needs to be revisited after any major life change, rather than treated as a one-time task you file and forget about permanently. Move number 7, and this one is genuinely optional. Consider whether a home equity line of credit is worth having in place purely as a safety net, even while you remain completely debt-free with nothing owed on the home at all. This is not a recommendation to take on debt for its own sake, and plenty of homeowners are entirely right to skip this step and simply enjoy being debt-free without any second guessing. The reasoning some financial planners offer is that a line of credit is often easier and cheaper to qualify for while you have no existing mortgage and strong equity built up, sitting unused and costing nothing unless you actually draw on it. Available quickly for a genuine emergency, rather than needing to apply for one under pressure after the emergency has already happened. And time matters most. Whether this makes sense for you depends entirely on your own comfort with having the option available in the background, not on any rule that says every debt-free homeowner needs one. Here is a bonus item, specifically for anyone with a meaningful balance sitting in a traditional retirement account, whether an IRA or an old employer plan. With your mortgage gone and your monthly expenses likely lower than they used to be, some years in retirement create a genuine window where your taxable income is temporarily lower than it once was, which is exactly the kind of year a Roth conversion, moving money from a traditional retirement account into a Roth account, and paying the tax now at a potentially lower rate than you might face later, tends to make the most sense financially. This is a genuinely complex decision that depends heavily on your specific tax bracket, your other income sources, and your long-term plans for that money. And it is worth discussing directly with a tax professional rather than acting alone based on a general video. But it is worth knowing this window exists at all, and that paying off your mortgage is often exactly the moment it opens up, whether or not you ever take advantage of it. Picture a man named Clarence, 68, who paid off his home 2 years ago, and like most people, simply felt relieved and moved on without a second thought about any of this checklist. When he actually sat down and worked through it, prompted by a conversation with his daughter, he found an escrow refund he never realized was still sitting with his old servicer. Discovered his homeowner's insurance was insuring his home for roughly what it was worth when he bought it 15 years earlier, rather than what it would actually cost to rebuild today at current prices, and had never heard of the new $6,000 senior deduction at all before looking into it that same week. None of these were dramatic mistakes, and nobody had done anything wrong. They were simply items nobody had ever specifically told him to check, sitting quietly unaddressed for 2 full years since his last mortgage payment cleared. Worth real money the entire time, he never claimed it. Here is the plan to actually work through this week. Call your mortgage servicer and confirm your escrow account is closed and any refund is on its way. Check your state's senior property tax exemption or freeze options using the earlier video if you have not already. Ask a tax preparer whether you qualify for the new $6,000 senior deduction and how the phase-out affects you specifically. Decide on purpose where your freed-up monthly payment is going, rather than letting it quietly disappear. Call your insurance company and request a current replacement cost estimate. Look into whether your state offers a transfer on death deed and whether it fits your estate plan. And if a meaningful retirement account balance applies to you, ask a tax professional whether this is a good window for a Roth conversion. Let us recap quickly. Paying off your mortgage is a starting line for 7 real moves: closing escrow properly, checking property tax relief, claiming the new $6,000 senior deduction if you qualify, redirecting your freed-up payment on purpose, updating your homeowner's insurance to actual replacement cost, considering a transfer on death deed where available, and deciding whether an optional home equity line of credit fits your situation. Everything in this video is general education, not personal tax, legal, or financial advice for your specific situation. So confirm your own eligibility and options with a qualified tax preparer, insurance agent, or estate planning attorney before acting on any of it. If you know someone who paid off their mortgage and quietly assumed that was the end of the story, share this video with them today. And if you have got a question about your own situation, drop it in the comments. Every Friday, I answer real viewer questions over on my Posts tab. If this helped you, hit that subscribe button and the bell so you catch every video the moment it goes live. A paid-off home is a genuine achievement, and it deserves a genuine follow-through. This channel provides educational information only and is not affiliated with the Social Security Administration, Medicare, CMS, the IRS, or any bank.